Hi, everybody. This is the investing teacher, and I am doing an exclusive interview with Marc Cohen. He is one of the founders from noguesstrading.com. Hi, Marc. How are you doing?
I'm great, Lance. How are you?
Doing great. Just a quick overview of why I reached out to you for this video. I saw a Seeking Alpha article that came out a few weeks ago, and it was a fairly controversial, so to speak. Definitely a new viewpoint on option selling, and it got a lot of different opinions on if it was a viable strategy or not. And as I'm looking now, you have almost, I think, 1,800 followers on Seeking Alpha. So congratulations on that.
Thank you. Yeah, we had a lot of comments on that article.
Yep. And I was very interested because I do quite a few of my option trades very similar to the methodology that you were doing too. One of the main rules that I noticed, rule number one, a lot of people, so to speak, say that you should only wheel and only option sell stocks that you definitely want to keep. And I think your thesis was almost the exact opposite up to a point. You want to elaborate on that a little bit?
Yeah, sure. So that's certainly a fine rule to trade options that you'd want to keep. And we do a little bit of that. But we think if you follow that rule, you're going to exclude yourself from a lot of trades that could be highly profitable. And there's ways to trade. It's hard to call them stocks you don't want to own, but more speculative stocks that, don't have any profits sometimes that people are bidding up with an eye towards the future. And you can still trade those with your options if you do it with certain safeguards in place that can broaden your portfolio and increase your returns.
Oh, great. Just curious, how did you start investing? Around what age, or what type of initial things did you consider when you were starting?
Yeah, so it's been a long time. I I started investing right at the top of the internet bubble, like late 1999, and it was fun for a few months. And I remember I went on spring break with my sister in March 2000 and came back, and that wasn't very pretty. So I lost a lot and I learned a lot from the early days. And then I began to trade options a little bit in around 04, 05, and that was fine, but it didn't fit my lifestyle at the time. I was young, I was working really hard, and options take a bit of work and attention, as you know. But I have traded ETFs and stocks all through that time, and started writing for Seeking Alpha 8 to 10 years ago, I think, and always looking for ways to use math to try and improve my ETF and stock trading, and then I turned that towards options more recently.
Back in early 2000s, how much did it cost to do an option trade? You remember about?
I don't remember. It was really expensive. Even stocks were, I think, $5 commissions on stocks was the new super low trade, and options were several dollars per contract. It was prohibitive to do unless you had a ton of money, which obviously I didn't have at that age. Nor do I have now. I don't think I would be able to trade any of the options that I do now if those commissions ever came back, and I don't think they ever will. Thank goodness.
Understandable. I had Vanguard for my Roth IRA, and they only about a year ago decided to go to $1 option trades, and they were way more than that. And I never even considered doing options before that.
Yeah, even $1 is about twice as much we pay now.
Oh, exactly. I actually switched from Vanguard to Schwab just because of that reason alone. I mean, I tried to call Vanguard, could you lower your rate to what Schwab did? And they said no. And I'm like, okay, I got to move.
You asked them for a favor, Lance?
It didn't quite work. You never
No.
know. Sometimes it works, sometimes it doesn't. Can't hurt to ask, right?
That's right.
So you were you studied physics in college, is that correct?
I did. I've always been a math nerd from the youngest age, and I love physics and how you can explain things with math and use math to find meaning in things that look like they have no meaning. And so we've used our math tools to try to find ways of predicting how the market will react and finding positive expected value in the market.
Oh, interesting. Could you elaborate a little bit on how you go about that?
Yeah, so our whole model is based on this idea of expected value. And my wife and I both love poker, which is kind of what made us start thinking about this. And the way casinos work and the way betting works, you can pretty much figure out what your expected value is from any bet in any game. And if it's positive, It means you're going to win in the long run. It
Mhm.
doesn't mean you'll win the next time you play. But it means if you play 1,000 times, you're likely to come out ahead. And so we tried to apply that to the stock market by looking for situations where you take the probabilities and you take how much you win or lose and you put them all together with the math in our articles, and you can determine whether it's worth it to place that bet on that option or if you should look for another option.
Great. Do you have a personal investing goal? I know in some of the articles, I think you aim around 2 to 3% a month, which ends up being anywhere between 24 to 36% a year or so.
Yeah, we shoot for 25 to 50%, just round numbers. It's funny to say that that's a goal. I mean, my goal is to make 500% a year
Yeah.
with no losses, right? That's my goal. But to manage the trades properly, we look for about 25 to 50%. I will say in the last quarter, the market has been outrageous. It's been giving us 150, 200% annual rates, which are not sustainable, but we'll take them while they're being given. But we generally want to get about 2 to 4, 2 to 5% a month.
All right, good. Any particular reason why you created noguesstrading.com? Were you more of a personal trader than you wanted to share it with others, or?
So I've always wanted to transition the Seeking Alpha articles to my own website. I've always enjoyed sharing these ideas with everybody. It's been a dream of mine for years and years. And then one day, my wife and I are working on the couch with our laptops, and she says, "Hey, baby, take a look at this." And she's built a website. She spent all day building this website. I thought she was doing her day job, and it's beautiful. And so from there, we just jumped in, and now the dream's coming true.
Awesome. I know you did mention a little bit on your option trading philosophy. You want to go over maybe a little bit why you're more of an option seller instead of an option buyer in many cases?
Oh yeah, option buying is, you not only need to be right, but you need to be really right, because you got to beat that premium. Option selling is the opposite. You can be wrong and still win. And the way we do it is, it's ironic that we're a high return strategy. 2 to 5% is really high returns when you look at the historical market. But our number one principle is loss prevention. And we try to make sure that we lose as infrequently as possible. We take trades way out of the money. So our philosophy, first and foremost, is keeping our win rate very high, keeping our losses very low. And if we focus on those two things, then the profits seem to come.
Yeah, great. Any particular reason why you decide on high implied volatility positions? I know if you go way out of the money, but those high IVs, they could fluctuate very dramatically.
Yeah, and the high, so it's all a question of how much you're getting paid versus what your probability of winning and losing is. So if you have a high probability of winning, you don't need to be paid very much to have a profitable expected value. If you have a low probability of winning, you need to be paid a lot more to make that a positive expected value. So when we go way out of the money, we don't get paid very much unless the IV is high. And we insist on going way out of the money because we don't want to lose. That's our first principle. So if we make sure, if our rule is you got to have a big cushion, then we need to look for the high IVs in order to make that cushion worthwhile.
Yep, makes sense. Recent trade this week, I had Riot, and it was at 60 and Monday morning. Decided to do an 45 cash secured put, and it dropped like a falling knife. It went down to 43, I think, at one point today, and then it bounced slightly up. It's like 46, 47. So it was a very similar strategy. I was about 23 something percent out of the money in a week, and it does happen. Is there any particular strategies you might do in a case like that?
Yeah, it's funny you mentioned Riot, because if you asked me to give an example, I would have given Riot as that's the example I give, where we sold a put, I don't know, 30, 40% out of the money about a month ago. Riot tanked like 25, 30%, but it never went below the strike. So here's a stock that fell 30%. We still won everything. So, when that happens, obviously we still win. If it goes below the strike, then we do trade management. And you can do things, Lance, as you know, with option selling. You just can't do either with stocks or even with long options. That when you sell an option, you can roll it. You can just keep milking time. Of course, with more time comes more risk. But if you can roll out and down, get yourself some credit, and some more cushion, you can generally bring a trade back to either even profitable, or you can cut your losses and down significantly. Either way, you can. That time is always a tailwind, and so we, except for biotechs that go from 10 to 50 cents, which we try to avoid. Generally, the high IV companies can be managed into a trade that is not a significant loss.
When a position goes in the money or at the money, really close to it, do you ever consider just letting it get a sign and go covered call?
Yeah, we do. It depends on the company. So for the solid companies, if we feel like it's a company we wouldn't mind owning, we'll allow the assignment to happen, and then we'll write calls on it. It depends on so many factors, Lance. If the calls are giving a lot of premium, even on a speculative company, we might take the assignment so we can get those calls. If we don't think there's any support for the stock, it's just going to keep going, we'll probably roll it out and down to try and, because if we assign it and put a call on there, the stock might keep going, might get a loss. So it's a case by case issue, but yes, sometimes we welcome an assignment. The irony is, I don't want to belabor this answer, but the irony is when a stock falls a lot and you're way in the money with that put, sometimes we want to be assigned so we can then start writing covered calls down here rather than having to hold this put that doesn't have any premium. So there's a lot of different ways to do it that selling options gives us.
I did that with GNUS. They do the kids cartoons and sold one at 250.
We've been in them a couple times, yeah.
And I was looking at it today. It's like 253, 52, and I'm like, if it hits 245 or so, I'm going to be overjoyed selling those covered calls in the other direction.
Yeah.
We'll see what happens tomorrow on that.
Yeah.
So I think one of the main, I would say, controversies in some of your posts is a lot of people, vast majority, want to sell particular stocks that they really want to own. And why do you, again, can you elaborate a little more? Why do you feel like that's not necessarily true? Maybe overrated, if anything?
Yeah, I think so. The risk when you sell options on a company that you might not want to own is that it tanks, right? And then you're in the money, or you're in the money with the put, right? And you end up risking assignment. The reason that we think that's fine is that those high IV companies tend to offer a lot of premium. So maybe there's an increased chance of loss, but our math tells us that the increased return outweighs that. And so in the long run, we may get burned a couple times, but we're going to win 20 times. And the high IV makes it worthwhile to do so that we're profitable in the long run.
All right, makes sense. Could you just general strategies on exit strategies? I see sometimes like you might give a recommendation. Let's say you could get $100 in premium. You might want to buy to close it at, say, $25 or so. Is there any just general parameters you might use to exit positions?
Yeah, we have an exit strategy. Again, it's based on our probability model. We usually take 50%. It's kind of our starting point. We will send a signal through our email service to buy a certain or to sell a certain option. And with that signal, we have an exit price right from the get-go. So as soon as you enter, you set a good to cancel order at the price we list, and then you just wait. And more often than not, within 6.4 days is our current average trade in 2021. You'll get that trade executed at a profit. My old mentor used to say, pigs get fat and hogs get slaughtered. So we try not to wait till expiration. We don't want to take all that. We just take the first 50%. If we get that first 50% in less than 50% of the time, great. That's even an extra bonus. But that also acts as more of a cushion. So we have a cushion in the price domain, and when we take profits early, we have a cushion in the time domain. And that keeps us further away from risk. It keeps us out of the market. We can adjust that depending on the volatility of the issue. So that's generally our exit strategy, is to take profits early.
All right, great. Is there a certain percent of people's portfolios you recommend that they just leave cash on the sidelines to possibly manage positions?
Yeah, so first and foremost, we recommend never trading on margin, right? So if you have a margin account and you do this, you can use margin for trade management if you need it. And that acts as kind of cash on hand. I think a safe rule is 70-30. You keep 30% in cash, you trade with 70. Occasionally, we will signal what we call a roll down and double, where you would take, say, a $3 put and you can roll it down to 3 times the number of $2 puts. And while it sounds like you've tripled, you've actually only doubled, because 2 times 3 is 6, right? So we sometimes signal a roll and double, and that takes a bit of extra cash, and it's helpful to have that on hand. And if you can do that, you can often turn a trade that's losing into one that's winning if you wait another week or a month.
Any particular hedges you do against large drawdowns?
Yeah, we don't do that, Lance. We get that question a lot, right? Because when we're selling these puts without a protective put, we are exposed. If the stock goes down 80%, we're stuck with a losing position that we'll then have to aggressively manage. But we find that, since at least 90% of our trades are winners, if we were to buy a protective put on every trade, the cost of that would just kill the system.
Yeah.
That the fact that losses are so infrequent makes those losses actually less in total than if we had to buy a hedge for every trade. So we take the losses when they come. They're rare, and we deal with them because we think the winners outdo it. If you want to have a hedged portfolio, you can buy bonds. You can buy a lot of safer assets. Our ETF system, which gets a lot less play than the option system, it isn't fancy or frilzy. It's designed to match the S&P, but the drawdowns and the risk profile is more like a bond. And we've written about this on Seeking Alpha. So if you want to keep that for a more conservative investment with less than 20% drawdown, but you still get market returns, you could do that. But if you're trading options and you want to get 25 to 50% a year, it's best to just take the losses when they come.
Okay. I know a different article you wrote about doing a covered call. I think you said it's sometimes good to go in the money in the covered call. Can you elaborate on that? Why?
Sure, way in the money.
Way in the money.
It's just like a cash secured put, right? So if you're 20, 30% in the money on a covered call, that stock can go down 20 to 30%, and you're not going to lose anything. That thing expires, and if the stock fell 29% but hasn't crossed your strike price, you keep all the premium. So the question is simply finding those opportunities that give enough premium to justify. And we can do that. We do that with our screens and our filters to find the right ones. They're not common, and generally they're the high IV stocks, Lance, that you trade.
Right. Can you explain to other viewers how your website, how your service might help them and help other traders?
Sure. So, if options trading makes 25 to 50% a year, why isn't everyone doing it, right? We get that question all the time. It takes a lot of work. It takes a lot of research. It's not easy. It takes a lot of time, and we've put a lot of effort into it. And so you can get the results of all that work by subscribing to our website. We send signals every day. We send about 12 signals every day, so there's always some to pick from. And the value is that we do all the math, we do all the screening and all the filtering and ranking for you. And we don't just do that on the entry side, but we monitor everything to help you manage the trade. We'll tell you whether to roll out, roll down and double, get out, let it assign, take a call. We manage all the exit strategies for you too. And we have the math on our side, and we use our probability model to tell us what's the right thing to do and what isn't. And if you want a piece of that, then that's why you come to the website.
All right, great. How could other viewers follow your service? What's your website again?
Yeah, so it's noguesstrading.com. Just like it says, we don't like to guess. That's the whole point, is that, if you ask me, people ask me, what's Apple going to do next week? I don't know. People study that. Their whole career is studying what Apple's going to do next week, and they're not always right. The point is, by having these huge cushions, both in terms of being in the money, high premiums, short durations, that we don't care if Apple's going to go up or down 10%. If we're 20% in the money, Apple can fall 19%, and I still make all that premium. So we try to set these up so we don't have to guess, and that's our motto: no guess trading.
All right, Mark. I did ask all the questions I have. Do you have any questions for me in particular?
I don't, Lance. I'd be curious to see follow along with your trading. If you could direct me to your webpage. I saw your YouTube. It looked great. But I thank you very much. This has been a great opportunity.
Yep. Okay. Thank you as well. This was Mark from noguesstrading.com. If you're interested, I'm going to leave a description in the link down below, and you can reach him. I know I just asked him a simple question if he wanted to interview me, and he got back to me immediately. So if any viewers out there might still be on the fence, or if they have any clarification, I'm pretty sure Marc would be more than willing to help you guys out. So thanks a lot, Marc, for all of your help in this interview.
Thanks very much, Lance. I appreciate it.
All right, everybody have a good day.
Take care.